Welcome back. You're watching Stock Watch with me, Simon Brown, and joining me to take your stock-related questions tonight, Bright Khumalo from Vestact and Wayne McCurrie from FNB Wealth and Investments. Please be sure to send your questions. Email stockwatch@bdtv.co.za or SMS 41392 or on X using hashtag StockWatch. Gents, appreciate the time. So we've got FOMC tonight, we've got MPC tomorrow. Let's start with predictions. Wayne, assuming we're going to get cuts both local and in the US, what do you think? Is it going to be 25 or 50 points?
And I think it'll be the US one's the only one that counts. I think it'll be 25, but 50 would come as a bit of a surprise, but wouldn't be impossible. And then tomorrow we'll just follow that.
You say 50 wouldn't be a surprise. Would 50 not spook the market a bit, and that we might worry that the Fed is seeing something we are not seeing?
Well, look, what I said is that 50 would be a surprise, but not impossible.
Okay.
So I don't think it's going to be 50.
Bright, what's your predictions for Fed and MPC?
I have no predictions, Simon. You know me, I'm regular, old, boring Bright. But when I was writing the message this morning, I did see that the guys on the Bloomberg index, they're pricing in a 55% chance of a 50 basis point rate cut. But they did say that what's going to matter a lot is the narrative around it. Because if you're cutting 50 basis points, you're basically saying that the economy is not in great shape. But we just saw retail sales yesterday showing that, as one indicator that the US market is fine and the consumer is fine. So 50 basis point, is the economy really on its knees, or you're behind the curve? So you have to say one. So you have to substantiate the why. Even if it's 25 basis points, the thing that's going to drive the market is going to be the why around it.
Yeah, well, look, I'm with you. I don't know what they're going to do. I hope they do 50 because I think we could do with it. And CPI today was 4.4 for August. And I was chatting with Johanna Els from Old Mutual. He says October local CPI could be 3.5. But let's go to some of the questions coming through. Bright, let's stay with you a moment. Southern Sun came out with a trading up to date. We saw Sun International, I think it was last week. We saw Southern Sun today. The leisure stocks are gaining some traction. Now, Sun International, a lot of that is betting money. But your take on the leisure, have you got a preferred stock? Is Southern Sun on that list?
Sure. The game in town for most of these leisure companies is obviously sports betting. So not all of them have exposure, and some of them that did have exposure actually unbundled, the gambling piece and left, the gambling properties on the side, and obviously the leisure on the side. So you have to pick, and you have to actually ask yourself if you want to invest in sports gambling or sports betting, as they call it. I don't know, man, but looking at these companies, like you're saying, including also City Lodge, I must mention that all of them are pointing towards, a better South Africa in terms of travel-wise, and obviously it means the consumer is, all of a sudden has extra cash to travel. I don't know where all the extra cash is coming from, but this could be a good indicator that maybe the South African economy is slowly turning around, or it could just be the reflection that electricity is now working and companies are spending less and less on things like diesel, and they're saving more cash, and obviously that goes straight down to the bottom line. And these things actually count in the long term because how much these operators are actually leveraged on the operational sides of the business. So a small percentage that you can save in any cost actually goes down straight to profit. They're very high operational leverage.
Yeah, I take your point on that. Wayne, I'm with Bright there. I don't like these sports betting things. I got issues with them. That said, the Sun International, there's perhaps more of a City Lodge. Your take on the Sun International stock, certainly trading just off all-time highs?
Yeah, look, these shares have done well. They've got a good environment. We're all forgetting that it's three-pot retirement stories. There's going to be huge cash injections. People are going to go gamble. They're going to go on holidays. They're going to spend that money very, very quickly. That all helps. when you read the trading update today, the turnover growth wasn't that great, but they're still going to show a decent increase in earnings per share. So that's not bad. I prefer Tsogo simply on the valuation. It just looks so much cheaper. And City Lodge as well. I think these shares are well priced for a better South African environment.
Yeah, and I've just checked, Bright. It's almost next week is 6 months of no load shedding. I didn't think I would ever make that statement, but here we are. A question.
Thank you, economy, or whoever has got, Eskom in the right path there.
No, it's actually quite wild. I mean, just a small matter of electricity. Who knew how important it was? Wayne, let's stay with you. We had the Raubex update today. I also got a question on the Twitters saying Raubex or what about Wilson Bailey? They're different in terms of where they operate, although Raubex is doing a bit in Australia as well. Raubex, obviously more South Africa, bit in Australia. Wilson Bailey, another stock chart that's looking impressive. Have you got a preference between either?
I'll probably go for Raubex. I mean, I think they both hit one-year highs today. Both share prices are up quite nicely. Look, the Raubex trading update was very good. The share was up strongly initially, up about 8 or 9%, up about 2% now. So it's come off a little bit. But yes, Raubex has actually done quite well over the last while. I mean, these are sole survivors, just about. If any boom does come and people start spending money a little bit more in that area, they can both do well, but I'll probably go for Raubex over Wilson Bailey. Although there's nothing wrong with Wilson Bailey. I mean, they had exceptionally good results, and then they hit that one disaster a couple of years ago, which really, really impacted them badly, and their reputation, excuse me, as well.
Yeah, there have been a stock that's done incredibly well, or a business that's done incredibly well, and there was the Australian issue. Bright, Raubex, Wilson Bailey?
Neither. I mean, it's a very fragmented market here in South Africa, but Raubex does have much more of an annuity-like income, well, should I say order book, with their contracts with the government, obviously fixing roads and other infrastructure here in South Africa. But, there's still a question mark of, tolls. South Africans don't seem to like tolls. So I don't know how we're going to go about actually fixing our roads in South Africa. So we need another alternative. I guess it's higher income taxes. I can't think of anything else.
Hey, you drive to the N3. That road is chock full of tolls, and Oaks just pay them. It was the tolls in Joburg.
Those ones we pay, but the ones here in Joburg, no one pays those.
Yeah, no one paid those. So here's a question, Bright. I gave you a hint up front. Finbond, they have gone and bought another US business. There was a sense out last week, or maybe actually there was a sense end of August saying that they're talking to a shareholder, which means potentially a buyout offer. Have you got any thoughts on Finbond? Because the inbox is full of people saying, should we or shouldn't we?
I think the company's American Cash Holdings, or whatever it's called. Look, this sounds like, I'm getting a deja vu, because back in 2016, Finbond went to America and bought a company called, you remind me here, Simon.
Payday loans.
Payday lending business, whatever, yeah. Yes, which, as you know, payday loans are not very, they're high interest rate, but it's not a very solid book. Like you were saying, in a year, they basically finish that book and start a new one. It's a very hard business. It's word of mouth and a lot of advertising, and it's probably spamming people. I don't see how this is any different from that. The share price in 2016 shot all the way up to around R6.10 and basically tanked to where it is today. I can see, if you look at the year-to-date numbers, they're looking healthy, meaning people are again are bullish on this one because of many different reasons, including the one you're mentioning today of this new business that they're buying. But I'm getting a sense of deja vu here. There's nothing to be excited about. It's still the old Finbond with lots of drama in the accounting. I don't want to get involved.
Yeah, in 2016, when we went to the US, it was literally weeks later when then President Obama also cracked down on this whole payday lending. Wayne, do you have any insight into Finbond, a stock you've ever looked at?
No, I've never actually looked at it, so I can't add any more than what Bright has said.
No, so hey, Bright knew a lot for a stock. I didn't think he would be able to. Wayne, let's stay with you. Let's touch on OUTsurance. We had some good numbers out from them yesterday. The stock has rallied, but I got to say, it was good numbers. I mean, Ireland is what cost them about 180 million, but that is in startup, so we expect that will start making money in a couple of years. Is there still opportunity here in OUTsurance?
I think so, yes. The numbers were much better than what certainly I was expecting, and obviously what the market was expecting. I actually quite like the short-term assurers. I know they hit a natural disaster every now and again, every 3 or 4 or 5 years, but they have they've got a massive advantage over many, many other businesses. They just reprice the next year.
Yeah.
They simply reprice it. And when you have a natural disaster, it affects everyone more or less the same. So everyone just reprices and you recoup those losses. So it's an automatically rebalancing business. I actually really like the short-term business, the short-term insurance business. You know, in 12 months later, after a disaster, you're back on your feet because you just charge more. So yes, and I think there is still more upside for OUTsurance, although the valuation for OUTsurance is obviously much higher than Santam. But I think justifiably so. So, yeah, I still think there's gap in the short-term market.
Yeah, and I totally take your point. You hit a disaster, you reprice, and you're off to the races. Bright, OUTsurance?
If there was a South African insurer I liked outside of maybe Sanlam, it definitely would be OUTsurance. Even you can even see it in their performance. Since listing, I think they're up north of 350% in a similar period. Santam hasn't done all that well. It's competition. It's been very hard in South Africa to operate in South Africa as a business. But these guys, somehow they've managed to just write new premiums, get new business, and carry on as if nothing is happening in South Africa. And obviously, most of the growth for a majority of the time had actually come from their UE business in Australia and New Zealand. So that's done very well. And obviously, you spoke about the UK business that's in its infancy. But yeah, I mean, it's a very well-managed business. The guys know what they're doing and they stick, to their quirky advertising, and people seem to like it. And even today, I know like they're probably close to 20 years old, but they do feel like the insurer that's still hip and young and active and still, know what's going on in young people's minds. And that's very brilliant to keep an image like that in people's minds, which is incredible. Even though they've competed with the likes of Naked and Pineapple, but OUTsurance is still in that sentence, in the same paragraph. It's impressive.
Yeah, no, I take your point in, and it does still seem like a young brand, even though it not quite so young. Let's come to some more questions coming through. Wayne, let's start with you. What about India? There's a Satrix Indian ETF. There's a question coming through on the emails talking around India. Certainly, I got actually an email this week from Old Mutual Investment Group saying India is the new frontier. I don't know how much you know about India as an investment destination and whether it offers opportunity.
Look, I think it does, but understand this whole India, Chindia, all of this stuff's been around for a very, very long time. So India's been offering opportunities of 8 years, 10 years maybe. Yeah. But yes, I think there are opportunities there, but you must always stick to basic principles. That you must have a diversified portfolio if you want to go into India, because there's huge upside potentially. I know lots of companies are investing into India. When you look at their GDP growth rates and their GDP forecasts, etc., it's very good. But just put 2 or 3% of your money into it. At maximum, put 5% of your money into it. They don't put 40% of your money into it.
Now, I take your point on that, and I hadn't realized that ETF's up 30% in a year. Bright, what about India?
Look, I tried this whole frontier play. You remember, you and I bought, I think it was the China ETF in 2020, and it hasn't worked out extremely well for us. Had we bought the Indian ETF, though, it would be a very different story in the exact same period. They seem to have, the regulatory side of things, very tight, and that's good. That's what you see. That's what you want to see from a stock exchange regulator in terms of the equivalent of a FICA to validate individuals, notwithstanding the many people that invest in Indian markets. And as a result, these businesses, they go through rigorous processes. I'm not saying China doesn't, but India seems to be more mainstream than what you get in China. And they don't have weird limits like volatility that a company can't go up 10% or down 10% in a day like you have in mainland China, which, by the way, you can't invest directly anyways, which I found very weird, that they'll have volatility limits there. It's an open market if you'd like to invest there. Just keep in mind that most of the companies that are big, sort of as they call it, the top 50 there is, it's basically mostly conglomerates and financial companies. Yeah. So it's kind of like investing in Hong Kong as well, or Singapore, sorry, not Hong Kong. You're going to get a lot of services companies, for a lack of a better word, and conglomerates that own basically everything. So there's not much that's exciting, and you're going to have to do some hard analysis if you want to invest in individual stocks there to find good technology companies that are ubiquitous and have cornered the market. I know there are opportunities there in some tech companies in payment spaces that are doing incredible things there, software as a service, and quite a lot of other sectors there, but I won't name specific companies. So if I were to invest again in India, I'll definitely go through an ETF. I wouldn't waste because the return on brain damage there is too high, unfortunately. So rather just take the easy route and invest in I don't know what they call it, because I know the Chinese ones are called dragons or
so this one is
whatever.
It's a nifty. Tiger. It's a nifty 50. Nifty so the index is the nifty 50.
This is the Tiger.
And you're right. It's all conglomerates, and it is a weird looking index. Bright, let's stay with you. Question coming through around Richemont. Been under some pressure. Chantal Marx, who's way smarter than me, always says when Richemont is sold off, buy it. What's your take, Bright, with the Richemont sell-off?
Richemont has been a core holding here at Vestact since I've been here, and apparently it was even 10 years before I arrived. So you should know my thoughts on Richemont. But personally, people don't understand the influence or maybe just how big Richemont is of a business in the luxury space. I mean, in terms of revenue, they're the second biggest. But in terms of overall market share, I think they're the third biggest, because they might be the second biggest again because Kering has been shrinking. So I guess it's LVMH number one, and then Hermes somewhere in between, and then you have Richemont. But Richemont is mostly hard luxury, so you're not gonna get soft luxury like you get a Gucci bag or this or that. It's either you buy a Chloe bag, a very fancy diamond ring, or a diamond chain or a bracelet. You're not gonna get something in between, and this is why it's quite an interesting holding. And for that, I really love it. And when it comes to all the fine crafted watches, you name it, all the number one names in their categories are all owned by Richemont. They're not. No one buys, no watch fanatic buys Louis Vuitton watches or Hublot, or because that's seen as an entry model watch, a $4,000 watch. In Richemont, you're buying a very expensive IWC, and that's what I would call they are entry model watches, but they're not cheap.
Yeah, they're not cheap. Wayne, Richemont, certainly it's sold off, but I take Bright's point. I mean, it's not your sort of handbags and alcohol, it's proper luxury.
Yeah.
Look, I can't disagree with Chantal because she'll beat me if I disagree with her. So I actually, but I do agree. If any weakness in the price, I think you got to buy it. I mean, I don't understand luxury at all. I've been inside one luxury store in my life, and I had a look at a pair of swimming trunks or baggies, cost about 6,000 Rand. And I thought, no, you've got to be, you must have no respect for money if that's what you pay just to get that brand. So I don't get it. I really don't. But obviously lots of people aspire towards that. And it is a good company and it's always done well. So yeah, I agree. You buy into weakness.
Yeah.
I mean, Wayne, I think you do understand luxury. You got nice cars.
Yeah, but that's very, very different. That's very different. They collect the cars. I don't drive them around to be seen in them. In fact, I never drive them, which is one of the problems.
And you certainly don't take. But when you're braver than me, I didn't even go into those luxury stores. I'm the kid at the window, sort of watching like a candy store or something. Wayne, let's stay with you. Momentum. We touched on insurance. Other side of the equation is momentum. And I know a lot of folks like it. And the question comes through: is momentum worth having a look at?
Look, obviously, you know my history with momentum, and I know a lot about the company. And look, the share price has done well. The earnings has done well. As a category, and the life insurance is a difficult market. It's obviously highly, highly competitive. But if we're going to get lower interest rates in a bull market, these are bull market stocks. So their earnings are hugely affected by investment portfolio returns. So, Old Mutual on the face of it looks much cheaper than Momentum, but I think that's for good reasons. So, yeah, I will go for Momentum sort of at this phase of the, let's call it the equity cycle, where we should still get half decent returns for the next year or two from shares. So, yeah, I quite like it, yeah.
Bright, Momentum?
No. No Momentum, no Old Mutual either.
No life insurers. I take, to Wayne's earlier point, I like the ability of the short-term insurers to reprice. So, Bright, let's stay with you. A question that came through, Naspers and Prosus. How come no one talks about them anymore? Should we still have them in our portfolio?
Well, look, they're still a majority. They still are not a majority, but a big part of our local index here, the top 40. So you can't ignore them. So definitely, I would still be buying, because I still think there's lots of opportunity for a catalyst there, more unbundling. There's just so much value to be received from buying these shares, because they're having a change of top management.
Yeah.
The old top management talked a good game, but actually didn't really show us much value. So I would say the new management, obviously they have their work cut out for them, but I think they have an easier job than the old guys, because the old guys had a very tough job to do.
Yeah,
and they didn't deliver.
I like
so the base is low.
And I like the look of the new management. Wayne, Naspers Prosus, which, as Bright says, is ultimately Tencent, and then some delivery apps.
Yeah, look, I think that the new management approach, or the new philosophy, is stop spending money and actually reap what we've spent already and make it profitable is the only way to go, because you can chase these startups forever. 1 in 10 might work, but it takes so long for it to happen, and you invest so much money there. So they must be absolutely besides themselves with joy that they didn't get eat, that they were outbid on that.
Yeah.
But they are going to reap. They are going to reap the benefits of the money that has been spent, and it's now going to come into actual profits and actual cash and some unbundling and maybe some selling. So yes, I still think there's upside, and despite the fact that you and Bright might have got burnt with Chinese exposure, these shares are cheaper.
No, they are cheap.
All we need is a little bit of good news out of China, and the shares can run strongly. And obviously, as you said, Naspers and Prosus is at the end of the day 10 cents.
Yeah, and they discount to 10 cents, which is cheap by any metric. But let's go to some stock picks. Wayne McCurrie, you're going with Anglo Platinum.
Yeah, look, I mean, I know this is an outside thing. I know it's risky. I know I've been wrong on this. I mean, the share price got down to just above $500 when Anglo American did that placing in the market. I don't know why they placed it so low, but I suppose the book build, you got no say in it. But the share price has recovered a bit since then. But the point is not today's share price. If we have a bit of a recovery in the economic cycle and a bit of a recovery in the commodity cycle as well, these platinum shares can go up strongly. I mean, I see the platinum and palladium prices are both up at about 1,000, so that's looking quite positive. And when you listen to management, this electric vehicle threat's been pushed out. I mean, they've seen no fall off in the demand from the autocat manufacturers for PGMs. So, and we all know a lot of motor car companies are pushing their EV targets out because no one's buying it anymore. At least they're not buying it nearly as strongly as what was forecast. So, I mean, it's still obviously a long-term threat, but in the shorter, medium-term, 2 years, 3-year view, these shares can rally strongly. So I know it's risky, but I'm going for Platts.
Okay, and Platts, Bright, we've got a minute left. You're going with AdTech.
Correct. The old trusty, Trinity House, Crawford Colleges, and obviously on the university side, we've got Varsity College and all other ones. I mean, I like this company. They provide private education. They're growing. It keeps growing in demand. I like the balance in brands, and I like the fact that they catch you. Once you're in that supply chain, or for a lack of a better word, or a brand, they catch you from grade triple naught, all the way to university with Varsity College. So it's impressive that one company actually owns all of these businesses. And I know earlier we talked about, the Sun International, the City Lodges, and the likes. Those companies, you're talking about them being profitable at 58%, 68%, 60%, occupancy. This company is always like 95, 98, 99% occupancy. So all of that operational leverage is really strong for this company, and they're doing exceptionally well. Yes, they might not look cheap on a valuation basis, but you're buying a growth company.
Yeah, you are buying a growth company.
Getting the growth. You're getting the growth as well.
Yeah, and they are great. And I like this. You get them in the early grade and they go all the way through. But we'll leave that there. That's all for tonight's Stock Watch. Thanks to our guests, Bright Khumalo from Vestact. He's going with AdTech, Wayne McCurrie from FNB Wealth and Investments, with Anglo Platinum up next. At the close, stay tuned.